Good morning, everyone. It is June 10th, 2022, and today we are going to have Sarah Steadfast with Newtown Mortgage and going over adjustable rate mortgages. Sarah, thank you very much for being here today, and I will turn it over to you after I tell everyone that everyone is muted. And if you do have questions, please raise your virtual hand or type it in the chat, and we'll get Sarah to answer it for you.
Great.
All right, Sarah.
Thanks so much, Tim. Good morning, everybody. I see I've got quite a few of our loan officers on here today, and we were just on a call a little while ago, and I twisted their arms to get on. So glad to see them on here too. So adjustable rate mortgages, I just wanted to kind of do just a little bit of a presentation about the adjustable rate mortgages because they're coming back. We all thought that they had gone away forever, but as the rates continue to increase, we're finding them to be a more popular option. It's only just starting, but I thought it would be a good idea to start to sort of give you an idea as to actually how these adjustable rate mortgages work. So what is an ARM? An adjustable rate mortgage, or an ARM, offers a lower initial interest rate for the first years of the loan, followed by regular adjustments based on the market at the time of the adjustment. And it's ideal for borrowers who would prefer a lower monthly payment during the first years of their mortgage. So how does it work? So we've got important terms. We've got the index, we've got the margin, we've got the caps, we've got the start rate, we've got the ceiling. Because obviously, if the interest rates are going to change, we have to figure out how that adjustable rate mortgage interest rate is actually going to be determined. So we start with the index. The index is what we call a benchmark rate, such as the secured overnight finance rate, SOFR is the new one, or the short-term treasury rate. And these rates fluctuate based on what market financial conditions are doing. You've probably heard of a LIBOR. LIBOR is an index that was recently retired just purely because I think perhaps it wasn't as accurate as it could be. So we're going to look at the index. So the index is your base that we're going to base the change of the interest rate on. The margin. The margin is the set amount that's going to be added to the index. And I'm going to give you an example in a little while. The adjustment period, how frequently the interest rates can change. Currently, what we're seeing is we're seeing 5/1 ARMs where it's fixed for 5 years and then becomes a 1-year adjustable rate mortgage. 7/1 ARM where it's fixed for 7 years and then becomes a 1-year adjust one every year, and then a 10/1 where it's fixed for 10 years and then adjusts annually. And in the past, we've had 1-year ARMs where it literally changes every year. We've had 2/1 ARMs where it's fixed for 2 years and then becomes adjusts annually, and 5/5 ARMs where it would be fixed for 5 years and then it adjusts and it's fixed for another 5 years. So all these things are there's a lot of options, but right now we're pretty much just in this 5/1, 7/1, 10/1 is what we're seeing. All right, so the start rate is the rate that it's going to be the initial rate, whether it's for the 5 years or the 7 years. And it's usually an enticingly lower rate than fixed rate loans, but it's only temporary. And what we're seeing with the ARMs right now is they're not as low on those initial rates as they have been in the past, but we think that may change as their popularity increases. So we should see some better start rates as we go along. Caps, the cap is the maximum amount the rate can change over the initial start rate or the current rate at each adjustment period. So we have the index, which is the market indicator of rate, plus a margin. And then we have the rate plus a cap. So those are kind of your basic things that you're going to be looking at. We also have a floor and a ceiling. There have been loans in the past when these ARMs first came out, they didn't have a floor. And all of a sudden you had a treasury index that was down at 0.5% and nobody had a floor. So they've decided to put in a floor and a ceiling so that you're actually capped as to how low or how high the rate can actually go. All right, so we're going to do an example. And this is going to be an example of a 5-1 ARM with a loan amount of about 350, which seems to be about our average loan amount at the moment. So we're going to say that this index is the 1-year Treasury. Now, you can go Google 1-year Treasury and it'll tell you what the rate is today. You can get the historical data on it, but this is kind of just a benchmark that we use based on the financial markets. The margin is 3%. So that means it's going to be the index, whatever the index is, the 1-year Treasury, plus a margin of 3, and that will give us one of the caps that we've got on our change. And then the caps on over the initial rate are going to be 225. So we'll see how that will change. So this particular example is going to start at 5%. We may have some slightly better, but we keep seeing the interest rates increase, so I'm thinking that 5 was kind of a good place to start. The floor is 3, which means it's never going to go below 3%. The ceiling is going to be the start rate of 5 plus the maximum cap of 5, so it could go to 10%. That would be your worst case. All right, so our example again is going to be a $350,000 loan amount. All right, so year 1 through 5, we're going to do a start rate of 5%. This is principal and interest only, $18.79 a month. And the asterisk is just saying that it's principal and interest only. Ruh-roh. Okay, so in year 6, so it's going to be fixed for 5 years. So in year 6, we're going to be looking at the start rate plus the cap, which would be 7%, or the index, which I just said for example purposes, would be 5% plus a margin of 3 or 8. So we're going to go with the lower of the two. So the good thing about this is that's the one we're going to pick. We're going to go with the 7% rate. So now this is going to adjust every year. So it's fixed for the first 5 years, year 6. And so then in year 7, we're going to look at the 7%, which was the rate we had previously, plus a cap of 2, or the index, which is to say if the market is worsening, say the index has gone to 7, plus this margin of 3 would be 10%. So luckily, again, we're going with the lower of the two, so it would be at 9%. And you can see that payment's gone up $1,000. So that's going to be a big difference. But if somebody's only going to be in the house for 3 to 5 years, this could well be the best way to go. All right, then in year 8, we're going to be looking at the previous year's rate plus a cap of 2, or the index, and I kind of said the index had gone back down, plus the margin of 8. So we're actually going to go with that one. Does that, I'm hoping that kind of makes sense. So you've got kind of these governors as to whether it's the index plus the margin or the current rate plus a cap. So that just kind of gives you an idea. And this could keep going up and down every year, depending on what the market is doing. So that's just to give you an example. Now, who would benefit from using an ARM? A home buyer who wants a lower monthly payment than a fixed rate. Right now, our fixed rates are in the mid-5s, so this would give them a slight advantage on the interest rate. These are conventional programs, by the way. FHA used to have some ARMs. We haven't really seen the popularity of FHA ARMs coming back yet, so we're using these conventional examples. A home buyer who plans on being in the home for a relatively short period of time, like I said, if they think they're only going to be there for 3 to 5 years. A home buyer can qualify for a larger mortgage due to the lower initial rate. So if you're looking at qualifying at 5.5% versus 5%, you may be able to qualify for a larger mortgage amount. A home buyer knows their income is going to improve dramatically prior to the initial increase in the payment. So there you have another situation where they know that they're going to be, perhaps they have a significant other, a spouse who is going to go back into the workforce. Perhaps they know that they're going to be the president of the company. Perhaps they're self-employed and they know that their income is going to increase. So that would be another reason for using this. Payment options. Now, typically, which is the example that I've shown, is a fully amortized rate. So that basically means we're going to amortize the mortgage over 30 years, which means you're going to have payments that will reduce the principal balance on the mortgage. Interest only used to be an option. We're not offering that at the moment, but an interest only payment would basically your balance would stay at 350. Your payment would just be interest only, which makes the payment less than a fully amortized payment. And in the olden days, we had these loans that had negative amortization. So that meant you made a certain payment, and whatever left over from that payment that wasn't covering the amount it would take to pay the loan off in 30 years actually got added to the end of your mortgage. So you would actually, your principal amount of the loan would actually increase. All right, that's it in a nutshell. Does anybody have any questions? Great. No questions.
Anything in
Okay.
the chat either.
Sarah,
Yes, Barbara.
I would just bring something up. So as an agent, a lot of times we might have a client and this is an avenue that they look at that they can financially afford because the first rate is so much lower. But can you talk about that a little bit?
Yeah, so if we go back to the people who are going to who's going to benefit from this? So if they want a lower payment, this would be a good way to start out. So they would be fixed for, in this example, 5 years, and it would be slightly lower than a fixed rate over 30 years. So they know that they're going to have that lower initial start rate at the beginning of the mortgage, and they'll know it'll stay the same for 5 years, and it will be slightly less than it would be if they went with a 30-year mortgage. Does that
and
make
a
sense?
lot of times people, when they're buying their first home, this is an avenue that people have used to get in, thinking they probably won't be in that house for more than 5 years.
Exactly.
So that's kind of been a benefit to something like this.
Right.
And usually if it's a starter home, then they're looking, hopefully over the 5 years, their salary has increased as well.
Exactly. So those are your reasons. One, they want a slightly lower rate than the fixed rate. They plan on being in the home for a relatively short time. It'll help them qualify for a larger mortgage due to the lower initial start rate. And the home buyer knows their income is going to improve dramatically. Those would be the reasons for someone to use the adjustable rate mortgage. Great question.
Hey, Sarah.
Yes.
So would they be able to refinance? Like say they use this to get into the property. Could they, in year 4, they like the way the interest rates are, could they refinance to
Absolutely.
a regular loan?
Absolutely. Yes. So, I mean, if they wouldn't have to be stuck at the 5%, they could actually refinance. Good question. The other thing about that too is, Heather, that if the rates are coming back down, what will happen is that index will probably go down too. So it's entirely possible that if this index goes lower, just as I showed in this last example, the index had gone down from the previous year. So the 1-year treasury we're showing had gone down to that. And Chris, what's the 1-year treasury today? Do you know? Can you look that? So if this has gone down, it may be that it has gone down enough that it will give them a beneficial rate that they might not even have to refinance, just because they know that the market is improving.
2.35.
Right. So today this index is 2.35. So looking at the 1-year treasury plus the 3% margin is 5.5%. So it would be beneficial to even stay in the mortgage, because I mean that is something that works with an adjustable rate mortgage. It does, which is what I was trying to show here, is it also goes down just as it can go up. It's not always going to go up. It's going to be dependent on what the financial markets are doing and what's happening with this index. But great question.
Okay, I have another one. I'm sorry.
Oh, please.
Could you go from one arm to another arm?
You could. You absolutely could.
Okay. Well, I think, okay.
But I mean, you're going to have, you would then be refinancing, so you would have your closing cost at the beginning, and then you're going to have closing costs again, just as you would with any refinance.
Right. Okay.
And then Sarah, I know you said there's no prepayment penalty for an ARM, correct?
Well, that's one of the things that you're going to need to make sure that there is not a prepayment penalty. This particular example that I'm showing does not have a prepayment penalty.
Okay, so if an agent is working with whatever loan officer, that is definitely a question that they need to ask, correct?
They would definitely need to ask that question. Yes.
Okay. Does
a great
everybody,
question,
Heather,
too.
do you know what a prepayment penalty is?
I do. It's when the loan is paid off prior to a certain date set, whether it's 30 years or 15 years, right?
Right. And then the lender would charge another percentage charge if you were to pay it off sooner.
Sarah, I don't think lenders can do that anymore.
Well, I don't think they can either, but you
Yeah.
just need to be sure. Because when TRID came out in 2015 and we started dealing with our closing disclosures and the 3-day rule, there are 3 reasons why a loan has to wait 3 additional days if certain things happen on the loan. And one of them is if it changed from a variable to a fixed or a fixed to a variable rate, if it has a prepayment penalty added to it, or if the interest rate goes up or down more than 1/8%. I think up. I didn't we just say up. I think they changed it to just saying up. But yeah, so there's a possibility that there could be prepayment penalties out there, and it is a good question to ask. Thank you. Anybody else?
I don't see any hands raised or anything in the chat.
Thanks, Sarah.
Okay.
Thank you all for
great.
being here today. Thank you, Sarah. If you're interested, we have the dot loop session at 11 o'clock. Have a great day, great weekend otherwise.